In this chapter of Get Rich with Dividends, the author discusses the benefits and drawbacks of using DRIPs, dividend reinvestment plans, and direct purchase plans to reinvest dividends. The author emphasizes the importance of reinvesting dividends to build long-term wealth and recommends finding a broker that does not charge fees for this service. However, not all brokers offer the same options, with some not allowing the reinvestment of dividends from foreign stocks. The author also mentions Scottrade's flexible reinvestment program. The author then discusses the advantages and disadvantages of using company DRIPs and DSs. While these plans offer convenience for those who prefer to deal directly with the company they are invested in, they often have higher fees and commissions compared to brokers. The author provides examples of companies like Altria and Clark's that charge fees for reinvesting dividends or purchasing stock directly. However, there are some companies that offer discounts to shareholders when reinvesting dividends, such as Aqua America and Healthcare Realty Trust. The author advises investors to carefully consider all fees and discounts before deciding whether to use a DRIP or DSPP. Overall, the author recommends using a broker for dividend reinvestment due to the convenience and lower costs, unless there is a significant discount offered by a company. The chapter highlights the importance of automatic reinvestment and the power of compounding dividends in building long-term wealth. In the book chapter Using Options to Turbocharge Your Returns, the author explains how options can be used to boost investment returns. Many investors are hesitant to trade options due to the perceived complexity and risk involved. However, the author argues that by selling options, specifically covered calls, investors can minimize risk and potentially earn double-digit returns annually. The chapter begins by providing definitions of put and call options. A put option gives the buyer the right to sell a stock at a specified price, while a call option gives the buyer the right to buy a stock at a specified price. The author then uses an example of buying a call option on Microsoft stock to illustrate how options work. The author goes on to explain the strategy of selling covered calls, which involves owning shares of a stock and selling call options against those shares. By selling covered calls, investors can generate income from the premiums received and potentially profit from the stock's price appreciation. The author emphasizes the importance of actively managing covered call positions and monitoring the market. The chapter also briefly discusses selling naked puts, which involves selling put options without owning the underlying stock. While this strategy can generate income, it carries more risk than selling covered calls. Overall, the chapter provides a clear and concise explanation of options trading and how it can be used to enhance investment returns. The author's engaging writing style and relatable examples make the topic accessible to readers who may be new to options trading. In this chapter of Get Rich with Dividends, the author discusses the benefits and risks of investing in foreign stocks. He explains that foreign dividend payers, particularly in emerging markets, can offer higher yields compared to American companies. However, these higher yields come with higher risk, as the stock may be mispriced or Wall Street may perceive it as riskier. The author also introduces the concept of lumpy dividends, where foreign companies may have inconsistent dividend payments due to currency fluctuations. He emphasizes the importance of understanding the risks involved in investing in foreign stocks, such as political, economic, and regulatory risks. Despite these risks, the author suggests that foreign stocks can be a good addition to a diversified portfolio, as they can provide higher yields and potential capital gains. However, he advises caution in not overweighting the portfolio with foreign stocks and recommends focusing on perpetual dividend raisers as the main component of the dividend portfolio.